Going into a discussion on incomplete records, and of course I'll make a presentation. If questions come along, put them in the chat and then I'll be able to pick them up. I'll be able to pick up the questions and then we can have them answered. So our discussion is going to look at cases where we have incomplete records, and in most cases some entities may not know the capital that they have used in starting the business. So we are going to look at how you can derive the opening capital balance if it is unknown. Okay, we are going to look at how to derive the opening capital balance if it is unknown. Time and again, entities may not be able to derive their profit. We are going to look at how you can derive the profit for the year if it is unknown. Then again, time and again, entities may not know how much they have drawn out of the business. Entities may not know, or a person may not know how much they have drawn out of their business. So we are going to look at how to derive the amount of drawings if these are unknown. Then time and again, entities have problems on how to determine the credit sales they have made in the year. So we are going to look at how to determine the credit sales using the trade receivables control account. And then we may be interested in determining the credit purchases, and we are going to look at how to derive the figure of credit purchases using the trade payables control account. And then finally we shall look at how to determine the cost of sales and how to complete our cash book using some very important measures like the margin. Sorry about that. We shall be using the margin, the markup, and of course how to arrive at the cost of sales if they are not given. So the major question is, why would the records be incomplete? Why would the records be incomplete? So on the slide we are saying that incomplete records or the problem of incomplete records usually occurs when the business does not have a full set of accounting records. If you have not been attentive in recording your transactions, if you have not been paying attention in maintaining books of accounts like receipts, vouchers, invoices, then you're going to experience the case of incomplete records. And it is a practice, especially in small and medium-sized enterprises, that they mainly they balance. You hear them talking about balancing. I'm balancing the daily sales. They usually focus on the sales, but don't focus on other records. So you find that the records are actually incomplete. That aside, incomplete records may also arise when your business accidentally loses some of its records, or some of the records are destroyed accidentally. So in that way we shall have issues of incomplete records. So this does not mean that we cannot proceed to prepare books of accounts. It doesn't mean that we cannot proceed to prepare books of accounts. We can still prepare books of accounts. Now, in an exam environment, when you're facing incomplete records or a scenario of incomplete records, the examiner is going to present to you a case where an essential figure is unknown. An essential figure will be unknown, and of course you know that there are certain figures that we need for us to finalize our accounts. So you find that some essential figure is unknown, and this must be calculated, and in most cases we are going to compute this as a balancing figure. In most cases we are going to compute this as a balancing figure. For example, the examiner may bring in a scenario where inventories were damaged or destroyed, and therefore you need to get the actual cost of sales, which is of course inventories are part of the purchases. So he's going to talk about goods that are damaged or destroyed, or he can simply give you a scenario where the assets are misappropriated or misappropriation of assets. So in the exam, you must add up the pieces. Even in practice, even if it is in practice, it's office work, or you have a client who is having incomplete records, your work is now to add up the pieces. Look at what is incomplete. How do I deal with this? So the task of preparing the final accounts will involve, of course, establishing the following. One, establishing the cost of purchases and other expenses, establishing the total amount of sales, establishing the amount of accounts payable, accruals, accounts receivables, and prepayments at the end of the year, and so on. Examination questions often take incomplete records problems even a stage further by introducing an incident such as fire or burglary, which leaves the owner of the business uncertain about how much inventory has been destroyed or stolen. So it is a very, very good area, and in most cases it may not miss out. It may not miss out because we feel this is one of the areas we can test your understanding. Your accounting is going to be put to a test. So how do we go about this? Our discussion will begin by addressing issues of opening capital. Our discussion will begin by addressing issues of opening capital. If the opening capital balance is unknown, what do we do? So whatever I'm giving you here is generally accepted. Okay, is generally accepted. So if the capital balance is unknown, then you'll need to prepare what we call a statement of affairs. You will need to prepare what we call a statement of affairs. The statement of affairs reflects the accounting equation, which is on your screen. Let me just highlight that. The statement of affairs reflects this. I know you have seen this before, the discussions we've had. So indeed, as you can see, assets equal to capital plus liabilities. So if you have the opening assets and the opening liabilities, you are in position to compute the capital balance. This is a very, very common case in the examination. Very, very common case in the examination. And in the scenario, in the exam type question we are going to do to support this foregoing discussion, it is one of the things we are going to determine. And in most cases, you will be given information about the assets, liabilities at the beginning of the period under review, but then we leave you to compute and tell us the opening capital balance, which is the proprietor's business capital, at the beginning of the financial year. So please take note that if the capital balance is unknown, then you're going to be required to prepare the statement of affairs. Next, the profit figure might be unknown. The profit figure might be unknown. So if you find that in your scenario the profit is not known, then you're going to use the business equation. You're going to use the business equation to derive the profit figure. That is the equation. So you get the closing net assets, which is equal to opening net assets plus capital introduced plus profit minus the drawings. So this equation, you're not going to be given this equation. So don't just sit back and say, these equations, we shall be given the equations. No, we shall not give you the equations. You must know these ahead of the examination. So we are saying that the most obvious incomplete record situation is that of a sole trader who has kept no trading records. It may not be possible to reconstruct his whole income statement, but it will be possible to compute his profit for the year using the business equation. Now, of course, this is also going to be part of the multiple choice questions. Actually, you might use this one mainly in multiple choice questions. The examiner may require you to determine the profit for the year. So the business equation will be very, very handy in that case. Next, our discussion will go into issues of drawings. Especially for sole traders, you find that in most cases these business people tend to draw money to meet personal needs, but in most cases they are shy to write down how much they have drawn out of the business. So you find that the drawings for the year are actually unknown. So what are we going to do? Now, of course, the concept here is that of business entity concept. And we are saying that the business entity concepts means that the personal transactions of the trader should be kept separate from those of the business. There is a case where the owner of the business may receive money, which may call personal receipts. So these must not be included in the receipts or revenues of the company. So on the slide, we are saying that the business owner may receive income into his bank account which has nothing whatsoever to do with the business operations. These amounts will be credited to his drawings account. So we have to, as a practice, if you know that the owner of the business keeps on receiving money, paying out from the business account, just open an account on the chart of accounts, and that is the drawings account. So what you do, that money should not be recognized in our business cash account. Instead, that money should be recorded. Yes, it has come on the cash account, but it is not ours. So as it comes on the cash account as a debit, it is taken out as a drawing. So we debit the cash account and credit the drawings account. So the personal receipts should be set off against the drawings. Now this may happen where the business owner maintains a personal account, and that personal account represents the business account. They may not open a business account per se, but use the personal account, which is, it is okay as long as you can maintain and record the transactions separately, those of the business separately from those of the owner. Again, as I've mentioned, the business owner may pay money out of the business bank account for items which are not business expenses, such as payment for his family holidays and so on. So we are saying that such payments should be treated as drawings and these should be charged to the drawings account. So if money is moving out of the cash account for personal expenses of the owner of the business, we shall debit the drawings account and credit the cash account. And thus we are saying that payments should be charged to the drawings account. Now, I need to highlight at this stage that drawings can be made in cash and in kind, like in the case of stock being taken for personal use. Where the business owner has taken goods from inventory for personal use, those goods should be taken out of the purchases and not included in our inventories. Like if you're going for a party, your business is dealing in maybe shoes, you're selling shoes, and your shoe is not good for the party, and you need a new pair. Of course, the first priority is to support your own business. So you may pick a pair of shoes from your business and forget to maybe pay. Or you can simply pick the shoe and use it for the function. In accounting terms, you have drawn inventories. So the accounting entries, we shall debit the drawings account and credit the purchases account. When we do this, we are taking the goods taken out of purchases. We are taking them out of purchases. And if we do this, we shall not include that pair of shoes in our inventories. The value of the goods taken is recorded at cost. Please take note of that. The value of the goods, the value of the goods taken is recorded at cost to the business, not at the sale price. So we shall not use the price indicated on the tag. Instead, we shall use the value at which we purchased these goods from the suppliers, because the profit is not realized. Why? Because you have taken the goods for your own personal use. The market has not given you that return on your investment, so we cannot recognize that profit. Next, you may find yourself in a scenario where the sales are not known, the credit sales are not known, or receivables are not known. In that way, we shall have to use the trade receivables contra account to try and reconcile between the opening and closing balances. Depending on the unknown, we shall be able to get the figure for credit sales or the figure for trade receivables. So on the slide, we are saying if a business does not keep a record of its sales on credit, the value of these sales can be derived from the opening balance of trade receivables, the closing balance of the trade receivables, and the payment received from the customers during the period. Meaning that you will need to use this pro forma. You will need to use this pro forma in order to determine the balancing figure. I'm going to share this slide immediately after the presentation, because we are going to use all these formats in the exam type question we are going to do today. So when you look at this format, this is a vertical format, the vertical format. You get the payments from the trade receivables, add on the closing receivables, the figure you get, deduct the opening receivables. The figure that you get are the credit sales for the period. If you don't want this vertical format, you can use the T format. The same thing, the T account. Because it is a receivable, it is an asset. The opening balance is on the debit, balance brought forward, closing balance on the credit. Cash received from the customers is a credit because you want to reduce on the obligation. The balancing figure are the credit sales. Again, of course, I'm going to share this on your WhatsApp so that we can have these used in the foregoing exam type question. Irrecoverable debts. If we have irrecoverable debts during the period, the value of the sales will be increased by the amount of the irrecoverable debts written off, no matter whether they relate to opening receivables or credit sales during the current period. We shall see that as we do our exam type question. Quite similar to this one here, purchases and payables. Now here we're talking about what you have purchased from your suppliers. If it is unknown, what do? Similar relationship exists between purchases of inventories during the period, the opening and closing balances of trade payables, and the amount you have paid to your suppliers during the period. If the credit purchases are not known, then you need to reconcile between the opening and closing balances of the payables, add to that the closing payables, deduct the opening payables. The figure you get will surely give you the credit purchases for the period. There is no way you can go to the exam without practicing on this vertical format. If you don't like it, you can use the T format. Because it is a liability, the opening balance surely the opening balance must be on the credit side. The closing balance is on the debit side. Purchases figure is the balancing figure. The cash we pay, which reduces our liability, is on the debit. So if you don't go for the vertical format, you can use the T format. On the other hand, we can still use inventories and cost of sales. So when you're given the cost of sales and inventories, this can be another way of deriving the purchases for the period. So we shall have the cost of goods sold, add on to that the closing inventory. The figure you get, deduct the opening inventory. The figure that comes down here will be the purchases for the period. Now, when you talk about cost of sales, gross profit and all that, you might need to apply the markup and margin. You might need these ratios. Now, to start with, we have the gross profit margin. The gross profit, when you talk about the gross profit margin, we are talking about profit as a percentage of the sales. We are talking about the gross profit as a percentage of sales. So that is what we call the gross profit. Then the markup, we are talking about profit as a percentage of cost of sales. Profit as a percentage of cost of sales. So you get your gross profit as the numerator, the denominator are the cost of sales times 100%. Now you might need the markup but you have the margin, or you may have the margin but you need the markup. So what do? Margin is the same as markup, 1 plus markup times 100%. Markup is the same as margin divided by 1 minus margin times 100%. You don't need to write. I'm going to share the slide. All of this, you're going to have it on your file. When you download and print, you'll have these as part of the notes. Now, assuming a scenario has been included in the question, and the examiner is saying that goods were stolen, goods were destroyed, and we don't know the amount. Now, if goods are stolen and destroyed, and we have this unknown quantity, now whether they are stolen, destroyed in a fire, or lost in any way such that the quantity lost cannot be counted, then the cost of goods lost is going to be computed as below. So there's a formula here, okay? It is narrated, but this is a formula. So you have to subtract A minus B. A minus B. A being the cost of goods sold minus the opening inventory of goods at cost plus purchases less closing inventory of goods at cost. In theory, these two must be the same. A and B must be the same. So if they are not the same, and you find that B is larger than A, then the difference must be the cost of goods purchased, which were neither sold or remained in our inventory. And therefore, that accounts for the cost of goods that we lost. Whether the examiner talks about fire, stolen, destroyed, it's the same thing. That's how you're going to do it. Now, most organizations subscribe for insurance. And if goods are lost, the insurance company is going to pay. Now, in accounting, the entries are going to be different in cases where goods are insured and in cases where goods are not insured. So we shall begin by looking at the accounting entries where goods were not insured. Management was adamant and they didn't insure the goods against loss. On the slide we are saying that if the lost goods were not insured, the business must bear this loss, and the loss is supposed to be shown in the net profit part of the income statement. So we shall debit that loss under administrative expenses and credit our cost of sales. And since the loss is not a trading loss, the cost of goods lost is not included in the cost of sales. A trading loss, when you are engaged in a transaction, buying and selling, and you make a loss, that's a trading loss. A non-trading loss is one that simply comes out of uncertain events like theft, fire, and any other event that may lead to loss of goods. So I hope you have taken note of that. If the examiner says that, you can be able to explain the difference between a trading loss and a non-trading loss. Now, if the goods are insured, management was cautious and they decided to insure the goods against loss, then the accounting entries would be, we shall debit the insurance claim account or the receivables account, and then we credit the cost of sales. Meaning that there is no charge at all in the income statement, and the appropriate double entry would be as stated above. The insurance claim will then be a current asset and shown in the statement of financial position. In the first accounting entries, you have seen that we have debited the expenses, meaning that we recognize that loss in the income statement. But here, because we have mitigated that risk, it becomes a receivable. We just sit back and wait for the insurance company to compensate us. No loss has been incurred. Now, incomplete records, always the cash book is not fully prepared, but we can still use the figures we have obtained to prepare a complete cash book. The cash book under incomplete records will help us in indicating the cash receipts and payments. So we are saying on the slide that the construction of the cash book, largely from bank statements showing receipts and payments of the business during the given period, is often an important feature of incomplete records. Here we must prepare the cash book. We must construct this at the end of the accounting period, and the items of receipts or payments that might be relevant when we construct our cash book include getting to know the amount of cash sales we have made, the amount of certain expenses in the income statement. We can also pick this from here. The amount of drawings on account of profit by the business owner, which happens because some of these businesses, as I mentioned, are small. I can be able to tell that I've made a profit of this much on this transaction. So in most cases, business owners tend to draw that money that has been made on a transaction, but the recording may not be done. So we can do this when we construct our cash book. Questions may still further consider issues of cash that has been stolen. Of course, here we shall be talking about theft of cash from the till. And we are saying that when cash is stolen from the till, the amount of stolen cash will be a credit entry in the cash book and a debit in either the net profit section, the income and expenses account of, or the income statement, or insurance claim account, depending on whether we had actually insured our cash from theft. The missing figure for cash sales, if this has to be calculated, must not ignore cash that has been received but later stolen. So if we are to determine the figure for cash sales, we should also consider the cash that was stolen from the till. Okay, finally, time and again, prepayments can be made, accruals might be incurred. For example, you might not fully clear your water bill, you may not pay your rent on time, so that one could be regarded as an accrual, or you may even prepare your rent. So in that way, the figure for accruals and prepayments may be required to complete the accounts. And where there is an accrued expense or prepayment, the charge that we are supposed to take to the income statement for that particular item could be, as I've mentioned, water, electricity, and so on. You will determine that figure by reconciling between the opening and closing balances of that item plus the cash payments you made in the period for that particular item. The charge in the income statement is perhaps most easily found as the balancing figure in the T account for the accrual or prepayment. So that is the presentation on incomplete records. So what I'm going to do now is to share the slide on WhatsApp, share the exam type question, give you some minutes to read through, and then we start.